Hello, my name is Colin and I'm a Senior Consultant Actuary at a firm called Isio. We're delivering this webinar on behalf of SPPA, who are the administrators to the police pension schemes in Scotland. This webinar follows on from the remedy material on the SPPA website, which you may have already seen. And in this webinar, we focus on the pensions tax annual allowance impact of the remedy. So you may be watching this webinar because you have received or expect to receive a remedial pension savings statement, or RPSS for short, and these statements cover the tax years from 2015-16 right through to 23-24. Hopefully, this webinar can help you to understand what the statement is telling you and what you need to do. If you received an RPSS, then you need to take action. It is separate and unaffected by your choice at retirement. So what we'll cover in today's session will be of a generic nature. We will go through a case study to illustrate how the effect of the 2015 remedy might play out on the majority of annual allowance tax charges, but of course it should all be taken as guidance and not financial advice. In terms of the topics that we'll cover, first we'll look at the UK pensions tax regime. As part of the UK regime, we will discuss the annual allowance, namely what it is and how it is calculated. It's worthwhile going through this, as although many people listening may have had tax charges in the past, this may have been some time ago and there will be others that will have an annual allowance tax charge for the first time as part of this exercise. We'll then pause on talking about pensions tax and turn our attention to the MacLeod remedy, who it impacts, how it impacts them, and when. We will then combine the two aspects of pensions tax and the MacLeod remedy together to focus on what its impact is on historic annual allowance tax charges. As part of this, we'll go through a case study, and then as this is a recorded session, there won't be any questions during or at the end of this presentation. Currently, we have a generous system of pensions tax relief in the UK, and it works on the basis of exempt, taxed. That is, contributions to a pension scheme are tax-free, and in the type of scheme that you're a member of, in the police pension schemes, which are defined benefit schemes, you're building up a benefit tax-free. The only tax that is payable is at the end when your pension is taxed as income. But even then, there is the opportunity to take 25% of the total value of the benefits you receive as a tax-free lump sum. As this system is quite generous, the government obviously have to have a method of controlling the amount of relief available. And it does this through the annual allowance, which we will talk about at length. Note that previously there was a limit on the amount of retirement benefits an individual could build up over their whole life, which was tested at retirement, and this was known as the lifetime allowance. But following the March 2023 budget, this limit has now been removed. The annual allowance is tested each year and is the maximum amount of retirement benefit that you can build up and receive full tax relief on. We use the term growth on the slide because of the nature of the pension schemes that you're members of, which are defined benefit schemes. So your benefit is building up or growing each year. Retirement savings covers both your pension and, if you're in a 2006 scheme, your lump sum. Note the asterisk on the slide. The annual allowance is measured over what we call a pension input period, or PIP. This used to make the calculation even more complex, as it could have been any period of 12 months. But in the tax year 2015-16, PIPs for all pension schemes were aligned with the tax year. So all PIPs now run from 6th of April to 5th of April the following year. This is quite a busy slide, but it highlights the changes in the annual allowance from 2015-16 to the recent March 2023 budget announcements. In general, the standard annual allowance for most people is 40,000. Since 2016-17, we have had a tapered annual allowance for higher earnings, which can be as low as £4,000 or £10,000 for some, depending on the tax year. You will see that there was an odd year in 2015-16, which is the transitional year when the pension input period was aligned with the tax year. For the police pension schemes, this split PIP, as we often refer to it, ran from 1st of April 2015 to 8th of July 2015, and then 9th of July 2015 to 5th of April 2016. From 2020-21, the tapered annual allowance changed. It now affects fewer people as the limits increased significantly, but the minimum annual allowance fell to £4,000 for the highest earners. We'll come back to this in a bit. There were further changes which took effect from 6th of April 2023. The annual allowance increased to £60,000 for the 23-24 year onwards, and the minimum tapered annual allowance rose back up to £10,000. So the annual allowance limits the amount of pension savings you can build up each year tax-free. Again, we use the term growth because of the nature of defined benefit schemes. You're building or growing a benefit each year. If you exceed the annual allowance, there is a tax charge on the excess at your marginal rate of income tax. There is only one way to reduce or remove an annual allowance tax charge, and that is through carry forward of unused annual allowance from the 3 previous tax years. We'll come on to this in a bit more detail later. Before we look at how the annual allowance is tested, there are a few important points about the responsibilities. Now, the annual allowance is a personal income tax charge, and therefore ultimate responsibility to account for it lies with you, the individual member. It must usually be accounted for through self-assessment tax return, although there is a distinct process around the 2015 remedy, which we'll cover at length as part of this presentation. But it is complex, so there are statutory responsibilities on other parties too. So the employer must provide the scheme with pay and service information, because without it, the scheme administrator cannot calculate your benefits in your defined benefit scheme without that information. The administrator has a number of responsibilities. So it must calculate the pension input amount. This is the name for the value of the increase in your pension savings over the year that will be tested against the annual allowance. You'll see this term referred to in your pension savings statement, and we'll use it regularly throughout this presentation. So if the pension input amount exceeds the standard annual allowance for a given PIP, the scheme administrator must send you a pension savings statement showing you the pension input amount for the current tax year and the 3 previous tax years. Also, it must pay the tax charge to HMRC if certain conditions are met and you ask it to. This means that instead of you paying the charge now from your net income, it would be deducted from your pension when you retire. We'll come back to explain this in more detail as we go throughout this presentation. But this aspect is commonly known as scheme pays. So there are basically 2 different types of pension scheme: defined contribution and defined benefit. In a defined contribution scheme, the pension input amount calculation is quite simple. It is the total employer and employee contributions paid to the scheme over the PIP, or tax year. But in the police, almost all the pension schemes are defined benefit. This means that you are not paying money into a pot which will grow over time to provide benefits. Rather, you are building up an entitlement to an annual pension. For final salary schemes, the 87 and 06 schemes, this is calculated using a formula based on the length of service and pay. For a career average scheme, which is the 2015 scheme, you build up a pension based on a percentage of how much you earn in each scheme year. So the government is not interested in what is being paid into a defined benefit scheme. Rather, the pension input amount is calculated as the increase in the value of the benefits you build up each year in the scheme, and this is then tested against the annual allowance. The pension input amount calculation looks at the difference between the pension and lump sum you built up in the scheme at the beginning of the year and the pension and lump sum you had built up at the end of the year after allowing for inflation. The difference is the amount of benefit built up in the year in real terms, and a value must then be placed on this to test against the annual allowance. For pension, the factor to do this is 16 to 1. So in crude terms, you can think of this as a rough life expectancy. Imagine a pension of £1,000 per year paid for 16 years would be worth £16,000. So this factor of 16 is a flat factor set by HMRC and is used by all schemes for members of all ages. If you're in the 2006 scheme, you're building up pension and lump sum separately. In this case, the pension input amount to test against the annual allowance is 16 times the increase in pension plus the increase in lump sum. Note that the lump sum is only paid once, not annually, so that a factor of 16 isn't applied to that. Since 2016, there has been an extra complication to the annual allowance for higher earners. If your total income exceeds a certain amount, your annual allowance can be reduced. There is a two-stage test to determine if you are affected. The first test is to add up all your income that is subject to income tax. So as you can see on the slide, this is not just your salary, but all of your income from your employment and also other income you may receive that income tax is payable on. So property income from properties that you own and rent out, investment income, and even pension income as well. The last item is where you are already in receipt of a pension from a pension scheme. This counts as taxable income. If your total income is lower than £200,000, you are not affected by the taper and your annual allowance will be £40,000. If the total is more than £200,000, you must move to the second test, which is called your adjusted income. To test against adjusted income, you must add up all the same things up again, i.e. all your taxable income, and then add in the value of your pension savings. So effectively your pension input amount from all the pension schemes that you're part of. So in the case of a defined benefit scheme, this is 16 times the pensions growth that we were talking about on the previous slide. This is then compared to £240,000, and if it's lower than £240,000, you are unaffected by the taper and you will have the full £40,000 annual allowance. If it exceeds £240,000, then your annual allowance will be reduced, and we will show you how on the next slide. Note that the limits on the slide applied from 2020-21 to 22-23. The note below the table explains what these limits were for 2016-17 to 2019-20. This diagram makes it a bit clearer how the taper works. So while adjusted income is under £240,000, your annual allowance is £40,000, and then it comes down in a straight line. As a rough rule of thumb, you lose £1 of your annual allowance for every £2 of adjusted income above £240,000. So that anyone with an adjusted income of £312,000 or more, the annual allowance is £4,000. Again, different limits for different years outside of 2021 to 22-23. Note that from 23-24 onwards, the adjusted income limit is £260,000 and the minimum annual allowance has been increased back up to £10,000. So we had mentioned carry forward previously, and so let's have a look at how it works. And it works in a very specific way. So if you exceed the annual allowance in the current tax year, so in the slide here we're talking about the 22-23 tax year, then you can look back to the 3 previous tax years to see whether there's any unused annual allowance that you can carry forward. So you start from the earliest year and work forwards. And the reason for that, of course, is that as you move from one tax year to the next, the earliest year drops out of the calculation. Where your pension input amounts are lower than the annual allowance in each of the 3 previous years, you can just see whether there is enough carry forward in total to offset the current year's excess. But in a situation such as that in the slide, you need to remember what happened in previous years as well. If this person doesn't look any further back than 1920, they may underestimate their carry forward balance because they may think that some or all of the unused annual allowance from 1920 was used up in 2021. But of course, in 2021, it was possible to look back to 1718. So it is necessary to look back to those previous 2 years to see if there was unused annual allowance which was used up by the 2020-21 excess, leaving the 1920 unused annual allowance still available. It does sound complicated, but the HMRC Remedy tool, which we'll talk about later, essentially does this calculation for you. And it is this reason that you need your pension input amount figures going all the way back to 2010-11, because that impacts the 15-16 year. We're now going to put a pause on pensions tax for a second and look at the 2015 McLeod Remedy. So this slide shows how the police pension schemes have developed over time. So you can see which one you're likely to be in if you're not sure. First, there was the 1987 scheme, which is a final salary scheme, and this was closed to new entrants in 2006. And new joiners instead joined the 2006 scheme, which is also a final salary scheme. In 2011, there was an independent review into the public service pension schemes over concerns that they were being too costly for the taxpayer. The outcome of the review was that all final salary schemes across the public sector pensions industry were to be closed and care schemes be introduced instead from 1st of April 2015. As well as new joiners going into the 2015 scheme, anyone who joined the police pension schemes after 31st of March 2012 were immediately moved over to the 2015 scheme from 1st of April 2015. Transitional protections were put in place for those closest to retirement, and they were allowed to remain in their final salary scheme or move into the 2015 scheme at a later date. A lot of individuals have therefore ended up with both a final salary pension from the 87 or 06 scheme and a care pension in the 2015 scheme. For these people, although no more service can be added to the final salary calculation, they are still linked to your salary, which can still go up over time. So in a year where your pay goes up by more than inflation, you will get real terms growth in your final salary pension, which contributes overall to your overall pension input amount for that year. And indeed, it is often a promotion or large pay rise which causes an individual to breach their annual allowance in a given year, because the impact of their legacy pension rather than on their 2015 scheme. However, there was a Victoria McLeod in the Judicial Pension Scheme who took the government to court over the transitional protections that were put in place, and she won her case. Likewise, there was Sargent in the Firefighters Pension Scheme who did the same but lost. The parties that lost both appealed the decision, and given the cases were so similar, the High Court took them together, and the result of a ruling was in favour of McLeod Sargent, that the transitional protections that were put in place were deemed to be discriminatory on the basis of age. The government was then tasked with removing this age discrimination from all the public service pension schemes, and it did this through what we commonly known as the McLeod Remedy. For more information on the remedy itself, you can visit the SPP Police Remedy Hub at the website address in the last bullet point. So this slide provides a visual representation of how members are affected by the McLeod Remedy. And there are three types of member as at 31st of March 2012, depending on how close they were to retirement, and the remedy impacts them differently. So for those that were more than 14 years from retirement at 31st of March 2012, these members were unprotected in that they didn't have any transitional protections and were moved into the 2015 scheme on 1st of April 2015. Fully protected members were within 10 years from retirement at 31st of March 2012, and they were allowed to remain in their final salary scheme until they retired. Taper protected members were between 10 and 14 years from retirement, and they were moved over to the 2015 scheme at some point between 1st of April 2015 and 31st of March 2022, depending on their age in service. Now, the remedy was split into two phases. The first was to move everybody into the same pension scheme. And as a commitment to the initial review of the costs of the public service pension schemes, everybody, regardless of previous protections, were moved into the 2015 scheme from 1st of April 2022 if they weren't already in it. The second phase was to do with removing the discrimination from the period 1st of April 2015 to 31st of March 2022, or what we call the remedy period. Legally, members' benefits were rolled back into their legacy scheme, either the 1987 or the 2006 scheme. However, it was acknowledged that some members may have been better off in the 2015 scheme, and so at retirement, members can choose if they want 2015 scheme benefits for this period instead. In terms of annual allowance tax charges, some people have had their position based on their legacy scheme, while others on the 2015 scheme. By rolling back everyone's benefits into their legacy and recalculating the pension input amounts will mean that everyone will be paying tax on a more equal basis. For unprotected members, they will have 7 years of revised annual allowance tax charges, potentially, and fully protected members' benefits are already in their legacy scheme, and so they won't receive an RPSS and aren't affected by this exercise. Taper protected members, like the unprotected members, will have up to 7 years' worth of historic tax changes to revisit. So now we look at how the annual allowance and the MacLeod remedy combine and are impacted. So first talk about this one-off exercise to correct historic annual allowance tax charges over the next 3 slides and the 3 following concepts. So we'll consider the information that you need to gather and where to get it, what you do with this information, and ultimately when you need to have it done by. So on 1st of October 2023, the second phase of the remedy was enacted, meaning that your benefits for the remedy period were rolled back into your legacy scheme. To do this, the scheme administrator updated and created a legacy record for you, and by the regulations, if there has been a benefit change to your benefits for a given tax year, then the scheme administrator needs to recalculate your pension input amounts for the relevant years and issue you with a remedial pension savings statement. With the information in your RPSS, you have to gather other information such as taxable income and details of any previous tax charges, more on this in a second, and complete the HMRC tool that has been set up for this particular exercise. From the HMRC tool, you will get your revised annual allowance tax position, and you need to decide how to settle any additional charges. If you had a tax charge for the 23-24 tax year, this needs to be accounted for through the usual route of self-assessment. Note that the 22-23 year isn't necessarily in the remedy period, but it's been delayed from last year. It can be completed through the HMRC tool, and self-assessment doesn't need to be amended for that year. In terms of the information that you need to gather, you need the updated pension input amounts for the police pension scheme from your RPSS, which was provided to you by SPPA, as well as any pension input amounts from other schemes. An important point to note is that the annual allowance is for you as an individual, not per pension scheme that you've grown benefits in. To test against the annual allowance, you need to add up the pension input amounts for all the pension arrangements that you've grown benefits in that particular tax year. If you previously had any tax charges from 2015-16 to 22-23, what was the charge and how was it paid for? You can find this information from either your own records, perhaps emails from SPPA, or if you have an online tax account with HMRC. Historic taxable income for the 2015-16 to 22-23 period, which you can get from your P60s and your own records of any other taxable income you've received, such as rent, investment income, and indeed any pensions benefits that you're currently drawing. We discussed on the previous slide that your benefits were rolled back into your legacy scheme on 1st of October 2023, and from early October 2024, RPSSs were sent out to the relevant population. We are aware that a handful of people have not yet received their RPSS, and these tend to be more complex cases. Or if you've had a requested a transfer from another police authority, then we are aware that this may have held up the production of your RPSS. Using your RPSS and the other information set out on the previous page, you need to complete the HMRC tool by the later of 31st of January 2025 and 3 months from when the date you received your RPSS. Although the initial deadline of 31st of January 2025 has now passed, we are not aware of any sanctions for missing the deadline, and HMRC are not asking for information about members' statement dates. Therefore, we are assuming that officers will not be punished for late submissions at the moment, but should take action as soon as possible. The deadline for informing the scheme if you intend to use Scheme Pays is 6th of July 2025, and I will cover more detail about this in our case study. Now to talk about the Remedial Pension Savings Statement, or RPSS. Before we look at the RPSS in detail, we do get a lot of questions from members asking why their pension input amounts have moved in a certain direction, and it will vary by age depending on the individual circumstances. The build-up rate in 2015 scheme is approximately 56ths, while in the 1987 scheme, the build-up rate of benefits is 60ths for the first 20 years of pensionable service, but 30ths for each year thereafter. Therefore, if rolling back to the 1987 scheme, it is likely that the pension input amount will go up if it results in one of these double accrual years where 30ths apply. In the 2006 scheme, the build-up rate is 70ths, thereby moving back into the 2006 scheme may actually reduce the pension input amount, resulting in possible refunds. However, the timing and size of any salary increases also have an impact on the direction of revised pension input amounts. In a final salary scheme, a large increase in pay combined with more pensionable service can result in an increased pension input amount, as an increase in salary in a care scheme only impacts that year and subsequent years, where with a final salary scheme, past benefits are also linked with this higher salary. Conversely, if salary increases have been below inflation, then rolling back into a final salary scheme may decrease the pension input amount, as the 2015 scheme care benefits are increased in line with inflation plus 1.25%. By the nature of the calculations, the difference in the retirement ages have no impact, as a factor of 16 is applied to any increase in pension benefits over the year, regardless of the scheme. Unfortunately, the common theme across police officers is that there are increased or new tax charges, mainly as a result of the double accrual in the 1987 scheme and having up to 7 years extra pensionable service in a final salary scheme combined with any promotional or large salary increases, causing these big spikes in pension input amounts. If you're unsure if you've received a remedial pension savings statement, then you would have received it in the post and would look like this. The first table is the pension input amounts for your legacy scheme, including the updated pension input amounts for the 2015-16 to 21-22 years, which represent your benefits for that period being rolled back from the 2015 scheme into your legacy scheme. This will also be the first time that you receive the 22-23 and 23-24 pension input amount figures. The second table shows the pension input amounts in the 2015 scheme. As benefits for the remedy period have been rolled back into the legacy scheme, this means that there isn't any pension input amounts for the 2015 scheme until the 22-23 year. The total pension input amount to test against the annual allowance is the pension input amount from the legacy schemes plus the pension input amount from the 2015 scheme and any other pension arrangements benefits have been built up in. The annual allowance is an allowance for you as an individual rather than for each pension scheme that you are building up benefits. From the March 2023 budget changes, 23-24 is the first year that a negative growth in the legacy scheme, say, can now be offset against the positive growth in the care scheme. Whereas previously, if there was negative growth In the legacy scheme, it was bottomed out at 0. So to summarise the RPSS, this gives you all the updated information you need from the scheme in terms of the build-up of your police pension scheme from the years 2015-16 to 23-24. Note that the 23-24 pension input amount is included in the RPSS and not in a separate PSS. There is a guide to your RPSS on the SPPA Police Remedy Hub, and that can be found at the website address on the second bullet point. As mentioned previously, you'll need to add the pension input amounts for the legacy scheme and the 2015 scheme together to give you your total pension input amount for each input period. Although for a lot of people in the 2015 scheme, pension input amounts will now be 0 for the 2015-16 to 21-22 period. If you built up benefits in or paid into any other arrangements during any of the tax years, you'll need to add these pension input amounts onto those from the RPSS. And as mentioned previously, HMRC have released a special tool to submit your revised information for the PIPs from 2015-16 through to 22-23. If you have incurred a tax charge for 23-24, this should be reported through self-assessment and not through the HMRC tool, which will only cover the period from 15-16 through to 22-23. So now to talk about the HMRC tool itself. So the HMRC tool can be found at the website address in the first bullet point. And this tool is being provided in order to calculate your revised pensions tax position for this one-off exercise. And it must be used to submit your results to HMRC unless you are using an agent. The first bullet point gives the address for the tool, which gives its formal name, calculate your public service pension adjustment, but we'll refer it to the HMRC tool. The main inputs required for the tool are the pension input amounts for the period 2010-11 through to 2014-15. These can be found in your RPSS and used to ensure that any carry forward position is correct for the 15-16 year. For each tax year from 2015-16 to 22-23, you will need the pension input amounts from your RPSS. If you have paid a tax charge in the past, what was the amount of the tax charge and how was it paid? From 16-17, you need to know your threshold income, basically your taxable income from all sources. If you're above the threshold income limit, then you will need your revised adjusted income, which in most cases is your threshold income plus your pension input amount. Everyone will need to have their taxable income for each tax year, as this is used to calculate your marginal rate of tax. Don't worry if you're unsure how to do any of the calculations, as the HMRC tool will do a lot of the work for you. You just need to enter the required information, and the HMRC tool will work out your carry forward or tapered annual allowance for you. In order to submit your results through the HMRC tool, you need to use a government gateway username and password. However, you can still use the tool without logging in so that you can have a look at the type of questions they are asking and do a dry run without having to submit any results. If you don't have a government gateway account, you can register for one at the website address on the screen. By signing in with your government gateway, you can save your progress and return to it later, as it may take some time to complete. The tool does have a triage stage at the beginning, designed to prevent members who do not need to complete the tool from doing so. For example, if the member never had any previous tax charges and their pension input amounts have gone down, then it is impossible for them to either receive a refund or have to pay extra tax, so they would be triaged out of the tool. If you have a tax charge to pay, you can decide whether to pay cash or ask the scheme to pay it on your behalf. If you want to use Scheme Pays, then you can select Scheme Pays directly through the tool without having to contact the administrator. So to fast forward now that you have recalculated your revised tax position and now have your results. So the remedy period and 22-23 tax years are split out into out of scope and in scope tax years. The earliest 4 years, 2015-16 to 2018-19, are the out of scope tax years. If your revised pensions tax shows that you had underpaid your tax for these years, you do not need to pay anything and no action is required for these years. If it was found that you'd overpaid your tax, however, you can claim compensation. The form of this compensation is covered in the next slide. The later years are referred to as in-scope tax years, and the main difference with these years is, if it is found that you had underpaid your tax, you are required to meet this additional charge. You will have the choice of whether you pay the additional charge by scheme pays or by cash. Similarly to out-of-scope tax years, if it is found that you had overpaid your tax, then you can claim a refund. Again, this is covered in a later slide. For out-of-scope tax years, if there is a refund, the form that the refund takes is the same as the form used to pay the initial charge. If you previously paid by cash, then you will receive compensation directly from the scheme. If paid by scheme pays, then the scheme pays debit will be adjusted down or removed as appropriate. The process for refunds for in-scope tax years is similar to the out-of-scope tax years, with the refund taking the same form as it was initially paid. The main difference is that if someone paid cash, then the money would be refunded by HMRC, whereas out-of-scope tax years you would receive the money from the scheme. Like the out-of-scope tax years, if you had paid the initial tax charge by scheme pays, then the scheme pays debit will be adjusted down or removed as appropriate. Now to look at our case study that should hopefully bring all these aspects to life. We have Julie, who was previously in the 1987 scheme and had tapered protection, meaning that she was moved over to the 2015 scheme on 1st of April 2016. Column A shows Julie's initial pension input amounts, i.e. before her benefits have been rolled back into her legacy scheme. Column B shows the carry forward from the 3 previous tax years, and column C shows the standard annual allowance, which is the same for each of these tax years at £40,000. The last column shows the taxable excess, which is the excess of the pension input amount above the annual allowance after taking into account any carry forward into this year. Please note that the taxable excess is not the tax charge, but we'll come back to that in a later slide. If we look at the 16-17 tax year first, we see that Julie had a pension input amount of £55,000, a standard annual allowance of £40,000, and unused annual allowance of £45,000 from the 3 previous tax years. And we can see that although the pension input amount is above the £40,000 annual allowance, there is enough carry forward to offset any excess, and so Julie does not have a tax charge for this year. Going into 17-18, we can see that the carry forward has reduced because some of it was used in the previous tax year. However, there is no charge this year as Julie's pension input amount is £38,000, which is below the annual allowance of £40,000. As it's below £40,000, this £2,000 of unused annual allowance can be carried forward into the 18-19 tax year, which is why you can see it's increased from £30,000 to £32,000. In the 2018-19 tax year, Julie has a spike in her pension input amount, possibly as a result of a promotion or large salary increase, and there is not enough annual allowance and carry forward to offset the pension input amount, leaving a taxable excess of £4,000. £4,000 is not the actual tax charge, that's the taxable excess. How the tax charge is calculated we'll cover in a later slide. But going into the 1920 tax year, Julie has again breached the annual allowance, with her pension input amount being £23,000 above the annual allowance limit of £40,000, and with no offset from carry forward as it was all used in the previous tax year. This highlights the issue that once you do receive a tax charge, you are more likely to receive one the next year as there is no unused annual allowance to carry forward. In 2020-21, there is no taxable excess as the pension input amount is below the annual allowance. As such, there is £6,000 of unused annual allowance to carry forward into the 21-22 tax year. Again, Julie is below the annual allowance in 21-22, and the £15,000 of unused annual allowance is added to the carry forward for 22-23, increasing it to £21,000. In the 22-23 tax year, we see that although Julie breaches the annual allowance, she just has enough carry forward and annual allowance to offset the pension input amount, and therefore has no taxable excess. Now we look at Julie's tax position post-rollback when all her 2015 scheme benefits in the remedy period are rolled back into the 1987 scheme. I appreciate there's a lot of figures on this slide, but we'll go through it slowly and through each tax year. So the first four columns of the table is just the table from the previous slide. The next four columns represent the same figures, but based on Julie's benefits being in the 1987 scheme for the remedy period. Column D represent the revised pension input amounts, and you'll notice that they have increased for each year, the main reason being that Julie is eligible for double accrual in the 1987 scheme for these years. Column E reflects the carry forward, which will have reduced due to higher pension input amounts, meaning there is less unused annual allowance to carry forward. With higher pension input amounts and lower carry forward, Julie is more susceptible to an increase in her revised pensions tax position. Note that the standard annual allowance is unchanged at £40,000. So, in the 2016-17 and 17-18 tax years, although the pension input amounts have gone up and carry forward reduced for 17-18, there is still enough annual allowance to offset the pension input amount, meaning no taxable excesses. In the 2018-19 year, the pension input amount has increased from £76,000 to £93,396. Combined with less carry forward due to higher pension input amounts in previous years, the taxable excess has now increased from £4,000 to £42,682. Similarly, in the 1920 tax year, with no carry forward in play, the higher pension input amount means that the taxable excess also increases. For the 2020-21 tax year, Julie was previously under the annual allowance, but is now just above it. With no carry forward, this means that Julie now has a taxable excess in this year when she didn't previously, before rollback. Fortunately, in the 21-22 tax year, despite the increase in Julie's pension input amount, she is still under the annual allowance limit of £40,000. However, the amount of unused annual allowance is reduced, meaning that there is less carry forward in the 22-23 year, and as a result, there is now a taxable excess. You'll note also that the pension input amount for the 22-23 tax year doesn't change, as it's not in the remedy period and so benefits have not been rolled back. So before rollback, Julie had taxable excess in the 18-19 and 19-20 tax years. However, as a result of rollback, Julie's pension input amounts have increased and these excesses have increased as well. Further, there are another 2 years now where Julie has taxable excesses, meaning Julie will have to pay more tax. Julie has to pay what Julie pays depends on whether the tax year is in scope or out of scope, and she will have to make a decision on whether any extra charges are paid directly with cash or uses scheme pays. So just a note on the tapered annual allowance. If you were subjected to the tapered annual allowance, then this will also have to be recalculated after rollback. So consider Julie's pension input amount for 2018-19. This rose from 76,000 to 93,396. If Julie's threshold income for 2018-19 had been £115,000, then her adjusted income would have been £191,000, and she would have been subject to a tapered annual allowance of £19,500. Following rollback, her threshold income decreases slightly due to a change in theoretical pensions contributions, which were higher in the 87 scheme than the 2015 scheme. But her adjusted income increases to £206,000. This means her tapered annual allowance for 1819 is now lower at £10,800. So Julie now has a higher pension input amount and lower annual allowance, which it would be assessed. But going back to the original case study, so for the out-of-scope tax years, we saw earlier that Julie had a taxable excess of £4,000, which with a marginal tax rate of 40%, appreciate these are tax rates for England and Wales and not Scotland, this meant she had a tax charge of £1,600. Now, post-rollback, she is faced with a much higher taxable excess with a revised tax charge of £17,073, meaning Julie had underpaid her tax by just under £15,500. However, as this is an out-of-scope tax year, Julie does not have to pay the extra charge. If the reverse was true, Julie had overpaid her tax, then she would be eligible for compensation, and the form of the compensation payment depends on how the initial tax charge was actually paid. For the in-scope tax years, we saw Julie initially only had a taxable excess in the 1920 tax year. The initial taxable excess was £23,000, and with a marginal tax rate of 40%, the tax charge was £9,200. Following rollback, the taxable excess and tax charge increased, meaning that Julie had underpaid by £5,768. Further, due to rollback, Julie has also an additional 2 tax charges in 2021, and we saw that with the reduced carry forward, this means we have a tax charge for 22-23. When Julie completes the HMRC tool and submits the results, it will inform HMRC of Julie's revised tax position. As part of that, Julie needs to decide whether to pay these increased tax charges using Scheme Pays or cash. The HMRC tool allows Julie to select whether she wants to use Scheme Pays for any of the tax charges without contacting the scheme administrator. If the opposite had happened and Julie had overpaid her tax, then she would be in line for a refund. Again, the form of the refund depends on how the initial tax charge was paid. And just a note now on the adjustments to Scheme Pays. So in the 2018-19 tax year, we saw that before rollback, Julie had a tax charge of £1,600. Assuming that she originally paid the tax charge by Scheme Pays, this would have meant that she would have had a debit of £105 deducted from her annual 1987 scheme pension, if she chose the 87 scheme to pay it. Now, we saw that the revised tax position for Julie was an underpayment of £15,473. But fortunately for Julie, this is an out-of-scope tax year, and so she does not have to make this payment. And therefore, there's no extra charges, and the Scheme Pays debits of £105 just remains as it is. For the 2019-20 tax year, if we assume that Julie had paid the initial tax charge of £9,200 using Scheme Pays from the 2015 scheme, this would have resulted in an annual reduction in her pension of £771. Following rollback, the revised tax position was an increased tax charge of £5,768, which, as it is an in-scope tax year, Julie has to pay it. If she decides to use Scheme Pays, there will be a debit of £370 from her annual 1987 scheme pension, as technically she no longer has any 2015 scheme benefits in this tax year. Note that Julie can opt to use Scheme Pays in the HMRC tool. But further, the existing Scheme Pays debit of £771 needs to be recalculated to come from the 1987 scheme because she no longer has any benefits in the 2015 scheme for that year. So the recalculated scheme pays debit is £591, which is slightly lower due to the early retirement age in the 1987 scheme to reflect that it will be paid for longer. So now to look at the 22, 23 and 23, 24 tax years, which are outside the remedy period. So although the 22-23 tax year is not part of the remedy period, it relies on the remedy period positions being correct for the carry forward of any unused annual allowance. And this was the reason why you wouldn't have received a pension savings statement for the 22-23 tax year. Your 22-23 pension input amount is included in your RPSS. And if you have a tax charge for 22-23, this is taken care of through the HMRC tool. You should not adjust any self-assessments for 22-23 or the remedy period as it is handled by the HMRC tool. The HMRC tool allows you to select to pay any tax charges using Scheme Pays without contacting the scheme administrator. The deadline for 22-23 is the same as the remedy years, in that it is the later of 31st of January 2025, or 3 months from when you received your RPSS. For the 23-24 tax year, your pension input amount for 23-24 should be included in your RPSS, and it requires your 22-23 position to be correct. If you have a tax charge for this year, you should report it through the usual approach of self-assessment rather than the HMRC tool. The deadline for self-assessment for the 23-24 tax year was 31st of January 2025, though you can still make a late submission. If you don't have your 23-24 pension input amount and you expect to have a tax charge, then you will need to submit an estimate. There is a video on the SPPE website that helps determine whether it's likely you will have a tax charge and then how to make an estimate if necessary. Once you receive your pension input amount for 23-24, you can then make an adjustment to your self-assessment. Following the March 2023 budget announcement, the annual allowance for 23-24 and subsequent years was increased to £60,000. This is also the first year that a negative pension input amount in one scheme can be used to offset the pension input amount in another, where previously the pension input amount was bottomed out at zero. To summarise and give you some actions for you to take away, the 2015-16 to 22-23 tax years, do read and understand your RPSS and seek additional resources if anything is unclear. Gather any other information such as your taxable income, details of any previous tax charges and pension input amounts from any other pension arrangements that you might have paid into during this period. Enter your information into the HMRC tool and submit using your Government Gateway username and password. If you are owed a refund, then it will take the form that you used to pay the initial tax charge. If you have more tax to pay, then you'll need to decide whether to pay directly using cash or use Scheme Pays. For the 23-24 tax year, this isn't to be reported through the HMRC tool, and instead this would be done through the usual route of self-assessment. The pension input amount for 23-24 is included in your RPSS. Similarly, you need to gather any additional information in terms of taxable income or pension input amounts of other pension arrangements if appropriate. Again, you need to decide if paying any tax charges directly or using Scheme Pays. Again, the deadline for reporting self-assessment was the 31st of January 2025, but you can make a late submission or an adjustment if necessary. So in terms of other benefits, for added pension, if you paid extra to buy additional pension in the 2015 scheme during the remedy period, you will be refunded, as following rollback it is not possible to buy additional pension in your legacy scheme. Your rollback pension input amount will reflect this. For early payment reduction buyout, if you opted to buy out all or part of your early retirement reduction for your 2015 scheme benefits, and you choose your legacy scheme benefits at retirement, then you will receive a refund for the cost of that buyout. For pension sharing on divorce, any benefits that have been subject to a pension sharing order since 1st of April 2015 will need to be recalculated based on rollback. If you transferred in service from another pension arrangement which is impacted by the McLeod remedy, this will need to be recalculated to reflect the rollback position. SPPA will carry out the necessary calculations, and this will be reflected in your annual benefit statement and RPSS. In terms of contingent decisions, a contingent decision in the spirit of remedy would be, if I hadn't been moved to the 2015 scheme, I would have done X instead of Y. If you believe you would have taken different actions had you remained in your legacy scheme, then there is a process where you can apply for retrospective change to be made to your record. This is in keeping with the spirit of remedy, which is to put you in a position that you would have been had the age discrimination not happened. An example of a contingent decision affecting your pensions tax position is if you subsequently buy back service in your legacy scheme when you had previously opted out of the 2015 scheme. The pension input amounts for the impacted years would need to be recalculated, as well as the pension tax position for the subsequent years that rely on the carry forward from these affected years. Information on how to apply for a contingent decision is available on the SPPA website. Thank you for listening to this webinar on pensions tax and the McLeod remedy. And please see this slide for various other resources for information.